Hey everyone, and welcome. Today, we are going to crack the code behind India's biggest market numbers. You know the ones I'm talking about. You see them on the news all the time. Sensex, Nifty. But what do those single numbers really mean? Well, if you've ever asked that question, you're in the right place. Let's dive right in.
So this is the big question, isn't it? You see Sensex at 75,000, Nifty at 23,000. These massive numbers are flashed everywhere, and they can feel, kind of abstract. Is it a score, a price, some kind of market temperature? Well, today we are going to pull back the curtain and demystify them completely. You know, I love this quote because it is just so true. For most of us, it's like a weather report. We see a green arrow, and hey, we feel pretty good. A red one, and we get a little nervous. But today, we're going way beyond that. We're not just looking at the forecast. We're going to get into the mechanics behind the forecast. We're going to understand the why behind every single point change. Okay, so let's move beyond that familiar scrolling ticker tape. It's time to uncover the real story these numbers are trying to tell us. A story about the health of the market and really the Indian economy as a whole.
Okay, first things first. What even is a market index? Well, at its core, it's just an indicator. The source material has this fantastic analogy. Think of it like a barometer. You know, a barometer measures atmospheric pressure to give you a sense of the weather. A market index does pretty much the same thing, but for the stock market. It measures the collective performance of a whole group of stocks to show you the overall market mood. It's really as simple as that.
All right, now before we get into the nitty-gritty of calculations, it's really important to take a step back and remember why the stock market even exists in the first place. Because it's not just a game of numbers going up and down. It's really a powerful engine for growth. See, on one side, you've got companies that need money, capital, to grow, to innovate, to build new things and create jobs. And on the other side, you have investors, people like you and me, who provide that money. And what do we get in return? We get to own a tiny piece of that company, a share, which means we get to participate in its future profits. It's this fundamental symbiotic relationship. Okay, this is what you came for, the main event. How in the world do we get from the performance of all these individual companies to that one single massive number, like 75,000 for the Sensex? Well, let's pull back the curtain and see how the sausage is made. So in India, we have two main barometers, right? First, there's the Sensex. It keeps an eye on the top 30 companies on the Bombay Stock Exchange, the BSE. Then you've got the Nifty 50, which, as the name suggests, tracks the top 50 companies on the National Stock Exchange, the NSE. So they're watching slightly different groups, but there's a lot of overlap. Basically, these are the heavyweights, the country's most powerful companies. And this right here is the magic formula. Now, I know what you're thinking. That looks complicated. It looks a little intimidating, right? But trust me, stick with me. We are going to break this down piece by piece, and I promise it's going to make perfect sense. The most important thing to see here is that it's all based on something called free float market capitalization. So how do we do it? It's actually a pretty simple four-step process. Step 1, you calculate a company's total value, what we call its market cap. That's just the share price times the total number of shares. Easy enough. Step 2, this is the important part. We find out what percentage of those shares are actually available for you and me to trade on the open market. This is the free float. The shares held by the founders or the government, they don't count here. Step 3, we take that total market cap and multiply it by that free float percentage. And finally, step 4, we do this for all 30 or 50 companies in the index, add up that final number for all of them, and plug it right back into that big formula we just. Okay, theory is great, but let's make this super concrete with a real-world example. Let's take a giant like Reliance Industries. Okay, so with some assumed numbers here for share price and total shares, its total market cap is a mind-boggling 16 lakh crore. But, and this is the key, if only 45% of those shares are actually in the free float, then its free float market cap, the number that actually moves the needle on the index, is 7.2 lakh crore. And this right here is why a big swing in a heavyweight stock like Reliance can literally move the entire Sensex or Nifty all by itself. All right, the last pieces of the puzzle are these base values. Now, don't overthink these. They're just fixed starting points that the exchanges set way back in the day. For the Sensex, the base value was set at 100. For the Nifty, it was 1,000. All these constants really do is make sure the final index number is scaled to something that's easy to read and track, instead of some crazy decimal. Okay, so we know how the index is calculated. But that brings up a new question. How does a company even get into this exclusive club of 30 or 50? Well, I can tell you it's definitely not random. Think of it like a really exclusive club with a strict velvet rope policy. Yeah, companies have to jump through some serious hoops. They have to be a major player in their sector, a real industry leader. Their financials have to be rock solid, and they have to be highly liquid, which is just a fancy way of saying their shares get bought and sold a lot. On top of all that, they need a clean track record and be transparent. So believe me, getting into the Nifty 50 or the Sensex, that is a huge stamp of approval. Now, with all this money flying around, all these complex rules, you might be wondering, okay, but who's the referee? Who makes sure everyone is playing fair? Well, you can rest assured the market has a very, very powerful one. And that referee is SEBI, the Securities and Exchange Board of India. Their mission is crystal clear, and it's all about three things: protecting investors like us, preventing fraud and funny business, and making sure the market as a whole runs smoothly and transparently for everybody. And this chart really shows you where their priorities are. Look at that. Almost half of everything they do is dedicated to protecting investors. That is job number one. Everything else, regulating the exchanges, developing the market, enforcing the rules, it all serves that primary goal of looking out for you. All right, so we've gone through the what, the how, and the who. We've covered a lot of ground. But now we come to the most important question of all. Why does any of this actually matter to you? How does knowing all this stuff give you an edge as an investor? Honestly, understanding these mechanics is like gaining an investor's superpower. For real, you can finally see why the market is moving, not just that it moved. You'll be able to spot when a big market drop is really just one or two heavyweights having a bad day, instead of widespread panic. When you buy an index fund, you'll know exactly what's inside. And maybe most importantly, you'll be able to make calmer, smarter, more rational decisions when it feels like everyone else is just reacting to the noise. So, to bring it all together, the next time you see that headline, Sensex up 500 points, you won't just see a number anymore. You'll see what it really is: the weighted, real-time, collective performance of the biggest and most important companies driving the Indian economy. Look, this knowledge fundamentally changes your relationship with the market. It moves you from being a passive spectator to an informed participant. So the real question I want to leave you with is this: now that you understand the story behind the numbers, what's your next move going to be?